Good morning, good afternoon. Hello, everyone. Thank you so much for joining us today for what I believe is our 44th installment of these community conversations webinars, which of course began way back in 2020. My name is Zachary Winfield, and I'm the Vice President of Zoo Advisors. In case this is your first time on one of these webinars or you're not familiar with our firm, Zoo Advisors is a full service consultancy based out of Philadelphia, Pennsylvania, and we serve conservation organizations like zoos, aquariums, botanic gardens, and other assorted green spaces all across the globe in areas like strategic planning, economics assessments, and executive search. If this is not your first time on one of our webinars and just looking at all your faces and seeing the names on the participants list, I see a lot of familiar ones. Then you already know that these sessions cover a very broad range of topics related to sort of the larger industry context. And today we're very pleased to have gathered really an all-star panel for an informal conversation that we are calling What's Ahead in 2022? And that's particularly through the lens of the rapidly evolving landscape in areas like economics, the labor force, travel and tourism trends, and just kind of the outlook in the attractions world generally in these uncertain times, as we're all used to saying. Now, when I say things are evolving rapidly, I think that it probably understates the rate at which stories are just popping up in the media on these topics, right? Just in the last few days, we've had headlines like Jamie Dimon sees the best economic growth in decades, more than 4 Fed rate hikes this year. And the Great Resignation, why more Americans are quitting their jobs than ever before. And consumer prices popped again in December as policymakers await an elusive peak. So these conversations are really just dominating right now as as media prognosticators, as they prognosticate about what's coming next. And generally at Zoo Advisors, we're thinking about really 4 key trends and how they might impact the industries that we serve. I'm sure you are all thinking about how they affect you as well. First of all, there's the supply chain, I guess the supply chain crisis. I'm not really sure what to call it. Depending on who you ask, we're either seeing a degradation of manufacturing and our ability to efficiently transport goods on one hand, or maybe these things are really just the same as it's always been, and it's more of an unprecedented spike in demand for goods and services. The second is, of course, inflation, right? Just 2 days ago, I think it was, the Bureau of Labor Statistics announced that prices increased, I believe it was 7% in December over the same period a year ago, which is the highest in 40 years. And we and many of our partners and clients are wondering, A, how long this trend will bear out, and B, how exactly to remediate the impact of this inflation of expense growth on our organizations. The third is the employment market, right? And the quote unquote Great Resignation. Again, depending on who you ask, a big chunk of the labor force is maybe quitting, or maybe they're just changing jobs in search of better wages, better lifestyle, better benefits. And the last, of course, is the outlook for travel and tourism and cultural attractions, which has obviously suffered mightily over the past 24 months. Now, all these trends are they're very large, right? Very macro. And I'm sure many of the attendees here today are wondering, what that means for them, what it means for organizations more specifically. So at the end of the day, I'm hopeful that our panel here can shed some light on that. As always, if you have any thoughts or questions, feel free to drop them in the chat. And yeah, so without further ado, I'd like to quickly tell you who our panelists are, and then we're going to give each of them a few minutes to kind of opine on these trends, what they're seeing as is applicable to their specific expertise, and then we'll move on to some Q&A. Joining us, we have Jamie McAndrews, currently of TNB USA and former Executive Vice President of and Director of Research at the Federal Reserve Bank of New York. We have Jerry Henry, CEO of H2R Market Research and longtime friend and partner of Zoo Advisors, as well as Erik Evjen, Director of Data and Analytics at Tourism Economics. So we're super happy to have the 3 of you gentlemen here to discuss these topics with you today. And I'd like to turn it over to James for a few minutes to tell us what he's seeing. Go ahead, James.
That's great. Well, thank you so much for having me. It really is an unprecedented economic climate that we're seeing these years, caused, of course, by the global pandemic, which is, of course, one of the biggest social trends in any of our lifetimes. The performance of the U.S. economy has been, extraordinarily uneven, and I think this is a reason why some of those headlines that Zach laid out seem so discordant to us. First of all, the boom that was discussed by Jamie Dimon, the chief executive of JP Morgan Chase, one of the largest banks in the nation. We are living through an extraordinary boom. Any economy has a rate of potential growth. It's sort of like a speed limit in the economy. And the United States, being an extraordinarily large and mature economy, has had a rate of potential growth of roughly around 2%. Most economists think it's slightly below 2% over the last 20 years. And that reflects population growth in the workers, and also the technological change and productivity increases. And you add the two together and you get this rate of growth. The economy can exceed the potential, but if you're exceeding the potential, then strains will inevitably occur and lead to price increases or inflation at the macro level. What happened when the COVID shock struck us in 2020 was an extraordinarily rapid destruction of jobs. About 8 million jobs were destroyed. The economy contracted in an extraordinarily sharp way. However, policymakers worked to provide extraordinary fiscal support to people and support from monetary policy. And we've seen one of the most rapid rebounds ever in the United States history. It's believed now that in 2021, so the year we just ended, that the growth will be about 5.5%. And that's real growth in people's incomes and output. And the Federal Reserve in its December meeting suggested that they expect growth in 2022 to be 4%. So these are far, far above that speed limit that I was talking about, the rate of potential growth. That's to be expected in some sense, given that we had such a dramatic contraction of the economy earlier. So there are unused resources. There are people who are out of work. They can be put back to work. So for a temporary period of time, we can grow much faster than that potential limit, as we saw in 2021. What's unusual with the COVID, there are two things that are very unusual with this recovery that we've experienced in 2021. First, the rapid growth, but secondly, the extraordinary constraints on supply. And Zach pointed these out. There are two basic constraints on supply. The first one, let's talk about this supply chain idea. During the period of COVID, people have been reluctant to engage in a lot of consumption of services, and this has to go with even outdoor services such as visiting zoos and so on. But people have been reluctant to visit restaurants, visit movie theaters, and so on. The basic services, go to doctor's appointments, go to other discretionary services and so on. Instead, there's been this extraordinary shift. We haven't seen a shift like this in years and years, in decades, from service consumption to goods consumption, buying more computers, buying exercise equipment, buying clothes, and things of that sort. That has put extraordinary strain on the logistics of getting goods to people. And that has caused these supply chain bottlenecks at ports and so on. Nonetheless, there have been more goods sold and delivered in 2021 than ever before in the United States economy. So that's the sense that we're really in a boom and we're pushing against these supply constraints. At the same time, the Great Resignation that Zach mentioned, people are quitting their jobs in numbers far beyond the level that they've ever quit before. And there are a host of reasons for this. We don't know all of the reasons. Certainly many workers who are aging have decided to retire from the workforce, about 5 million people, much larger number than has been expected. But also people in low-income occupations have been showing a greater willingness to resign. Partly there's been some government support along the way, but in addition, there are many jobs out there that people can take, and as Zach mentioned, they're trying to bargain for better opportunities, work closer to home and with better benefits. This has caused this incredible churn in the labor market. Nonetheless, we have now, as of the most recent report, an unemployment rate of just 3.9%, a very low unemployment rate by historical standards. But the total population of people wishing to engage in work, which is called the labor force, is still depressed from that contraction that we saw in 2020. And it's expected that over time, some of these people who have left the labor force, either into retirement or just sitting out, will return and will continue to sustain the growth in labor that we've seen. But these supply constraints, combined with the extraordinary growth that we've seen, has led to this bout of inflation that we're seeing, as Zach mentioned, highest in 40 years, 7% increase in consumer prices from a year ago. The question is how long this will stay around, and no one knows, but the Federal Reserve has taken a stance that it is going to be less accommodative in its monetary policy in the coming year, and with the intention of slowing the growth in inflation and slowing inflation down. Financial markets tend to agree with the Federal Reserve. Their 5-year inflation rate is based on Treasury market prices, is only expected to be about 2.8%, so not much above what we've seen in the last decade. But this will be one of those big stories that will continue to engage all of our attention, because inflation affects everyone's budget so much. We'll just have to see how the year proceeds, hoping that inflation will have seen its peak. Many models suggest December was the worst month for inflation, and that by the end of 2022, they're hoping inflation will be down between 3% and 4% and continue to fall back to that 2% range that is the Federal Reserve's objective in coming years. So these sorts of discordances between people resigning from their jobs, even while more and more jobs are being generated, very high growth, and yet people have trouble getting goods from China to New Jersey and so on. These are a very the surprise is that the economy has grown so fast, and yet people's views of the economy are not extremely optimistic. People's views of their personal finances are very optimistic, but the economy is facing such incredible challenges through this pandemic that I think people simply don't know what to think about the future. So the good news is that this growth is something that I think provides the hope that the economy can continue to sustain the jobs and futures that that we all hope for. So I'll stop there and look forward to hearing the comments of the other panelists. Thanks.
Thank you so much for sharing that with us, Jamie. I'm sure there'll be lots of questions and follow-up on that as we continue here. I'm going to turn it over to Jerry Henry from H2R Market Research to tell us about what he's seeing.
Well, good afternoon, everyone. I appreciate you tuning in this morning or afternoon, wherever you happen to be. As Zach said, my name is Jerry Henry. I am the Chief Executive Officer of H2R Market Research. H2R is a research consultancy that specializes in attractions, leisure, and the tourism industry. Probably what we've done for the past 7 years is once a year we conduct a massive nationwide study of attractions visitors, and we do it, same question, same time of year, and what have you. So we just fielded that and got results back, and so we have a little bit of an understanding of at least consumer mindset, or what they're thinking, how they're feeling, and what have you. Obviously, over the last, we'll say 2020 was no surprise. That was a dumpster fire for most of us, because we got shut down and we had mask mandates and a variety of things. Last year at this time, though, so we'd come out of 2020. Last year, attractions consumers nationwide were pretty bullish about 21. They were expecting that there's going to be a rebound in the neighborhood of 50%. And that study indicated that, we ought to probably in 2021, we'll get back to about 2/3 of the aggregate attractions industry demand that we had in 2019. In the study we just finished, they were pretty close in that they indicated that growth was a little over 60% and got us pretty close to about 3/4 of the way. So about 73 to 75% of the aggregate demand that they self-reported for 2019. So we still got a ways to go in demand. Interestingly, sales are a completely different story. We started hearing that empirically from our clients across the country pretty early in the year, that their sales were doing great. Per capita spending was pretty awesome. And so we added that to our survey too. Sometimes people don't necessarily know they're spending more, but in this case, we did find that about 30% of attractions visitors told us that they were mindfully spending more money than they had in the past. And that was up against 11% who were actually trying to decline. But it leaves us with 19 points, or almost 20% of customers who are mindfully spending more. And the reason they tell us they are spending more when they go out to attractions is A, they were tired of being cooped up for a long period of time. And you know what? They had pretty good savings during all that. They weren't spending on services. So they had some money, but more importantly, they were ready to splurge for themselves. They're ready to treat their families and get back out. Probably the best news of all of that is roughly 2/3 of them say, and I'm going to continue doing that into 2022. So at least those that are mindfully spending more, if 2/3 continue, hopefully we'll continue to see pretty strong per caps this year as well. In that study, a variety of records were broken, but you kind of expect that in this kind of topsy-turvy environment. But the good news is our outlook is very encouraging. As a matter of fact, year over year, I've never seen as strong of intent across 20 different sectors of attractions as we saw in this year's study. It's general intent to get out and visit attractions. It's specific intent to go back to an attraction that you visited in the past year. And we even ask it several other ways to measure it. What's driving that, though, is there's still massive pent-up demand out there, which we measure with a calculation we call unconverted intent. Last year was a record high, which we'll probably never see again, where we had 65% of potential demand was not being fulfilled. Typically, that's not unusual, because when consumers rate intent on any survey, their eyes tend to be bigger than their stomachs. And so they usually estimate intent far higher than their actual incidence would be. But normally that runs 40 to 50%. And we saw it at 65% in 2020. And the study we just finished, it's still at 62%. So indicating there's a lot more desire to visit attractions of literally all kinds than they were able to do in 21. And that is fueling their desire to travel, to visit attractions and to get out and spend on leisure in many forms. So from a consumer side, they absolutely appear to be ready, willing, and able to get out and travel. The one caution, of course, is while consumers appear to have pretty good intentions, they're ready to get back out there. They're ready to get to some sort of normal. The very things that we've been talking about in terms of supply chain issues, labor shortages, which cause longer wait times, inflation, and Omicron by itself, are all things that, well, despite consumers' good intentions, if we have too many disruptions in the actual experience, that could throw us off. But if not, last year we were calling for cautious optimism because we saw us only getting back demand to about 2/3. If consumers have their way and they follow through on their intentions, our demand should be back to 2019 levels by the end of 22. With per caps higher, we could be looking at a record financial year for many different attractions in 22. Keep your fingers crossed. I hope all goes well with labor issues and supply issues. And Zach, that's my little intro.
Thank you, Jerry. We appreciate it. Next up, we have Erik Evjen, who is Director of Data Analytics at Tourism Economics, which is a wing of Oxford Economics. So Erik, tell us what you're seeing in your world.
Thanks, Zach. It's great to be with everyone this afternoon, or again, like morning, depending on where you are in the world. But yeah, so tourism economics, we're the tourism practice of Oxford Economics, which is a global economics and forecasting firm. What we do and specialize in is combine an understanding of the travel sector with the proven economic tools to answer most questions facing our clients, which it's mostly, again, travel related in terms of what we deal with on our end. If it's okay, I want to share a few slides, and I'm going to move through them super quick. I think James and Jerry covered some of it, the content already, and we're going to have more conversations after. But I'm a visual person, so I'm gonna share my screen real quick, and again, we'll move through this fast. And again, trying to kind of bridge that gap between what we're kind of seeing in the economy, but also how that will impact the travel industry specifically as we move forward. So over the last 20 months, it's been quite a story, and every story has a setting, characters, conflicts, antagonists, and an ending, and usually a good one. And we believe that for the travel industry and the economy in general, that's going to be the case this year as well. So we kind of organized this into 4 chapters, if you will, and we'll move through this super quick, but we're going to look at some storm clouds and resilience, the economy as a driving force, especially on the consumer side, but what could possibly go wrong, right? And then some of the alleviates and positive indicators. So let's just begin here. COVID remaining a factor, obviously, with concerns impacting consumers' decision to travel, whether that be residents traveling within their own community, or visitors, both of whom you all depend on for your businesses. COVID's still a factor, with about 9% saying they're canceling trips. Now, the good news is that 24% are saying that it's not influencing their travel plans at all. So this is a study from Longwoods and Miles, who's been doing this every 2 weeks for the last year and a half, and continue to put out some good research on consumer sentiment. Now, in the face of that, we haven't really seen a knock on travel. Travel in general has shown a remarkable resilience, which is prevailing some of the headwinds that we're facing. And here's air travel just related to 2019 levels. And you can see we're currently at about 80% of 2019 levels, which is essentially the same as we were seeing in July which was right before the Delta variant kind of exploded on us. And we saw some continued improvement throughout the fall. We're also seeing in the hotel data, and here we're looking at hotel occupancy versus 2019 for 2021. Travel is behaving much more bravely now than what we've seen at any point during this crisis, and we believe this will endure going forward. And as you can see, while I think James mentioned earlier, the economy has been impacted very differently around the world and even within the U.S. In certain areas, but that has also been true on the travel side of things. Very disparate in terms of what markets have performed well versus others. Larger cities and metro areas are still struggling more than some of the rural areas. So looking at the economy, which is the main focus today, unemployment rates, we touched on this already. I'm not going to dig into this too much. Obviously close to the 2019 range and historic lows. But the historic struggle too on attracting and retaining workers, especially on the leisure and hospitality industry. 1 in 10 jobs are currently sitting open. And so if you're at a business, running a business with 100 employees, that means you have 10 open positions that you can't find people for. Obviously, the quit rates and historic high quit rates obviously being a huge challenge in the economy in general, but also within our industry. This is obviously one of the reasons for why we've seen an increased wages across all industries. Again, slightly higher on the service side, but this is really something that's impacting all of us. Now, we are expecting the labor force participation to rebound. We'll get into this a little bit more later, I believe, and I'm happy to answer any further questions on this. But there are a lot of reasons for people not entering back into the labor force that is improving. So we are expecting that to rebound somewhat. Household wealth is well positioned. Balance sheets of households have been extremely strong and is extremely strong right now. This will fuel continued household spending going forward, and especially on services side as well. This leads us to our view as a company that consumer spending will continue to be strong in 2022. We saw a huge increase in 21, and we expect that to continue into this year. Not just about the growth in spending, but also how that spending is shifting towards services again. During early times in this crisis, majority of the consumer spending was on goods. But now we're moving towards a full recovery also on the consumer spending and travel related items, which is nearly back to 2019 levels. And yes, consumer on the goods side is up about 20% over 19 levels. Some of that being impacted by the increase in cost. But again, good to see that travel is also again regaining some of that share of wallet among consumers. Consumers continue to behave according to the red line, which is confidence, as opposed to how they feel, which you see in sentiment in blue here. I think this was mentioned already, like how people have been feeling has been very different than how people have been behaving throughout the last 18 months. I can feel uncertain about travel, but I will still travel. I can feel like I want to quit my job, but I'm still going to show up today. There are all these things that people still continue to have a high confidence in terms of the consumer side. Omicron, we'll see a little bit of a speed bump in Q1. Things have been gradually improving up until then. We put a temporary chill on GDP. We'll put a temporary chill on travel in general. But when you're looking at a kind of the big picture here, we're already experiencing a very different recovery than what we were seeing during the great financial crisis, which took us over 3 years before we fully recovered. From an economic standpoint, it's taken us less than 2 years to fully recover. It's much more of what we would call a classic V-shaped economic recovery and we expect that momentum to continue into the future as well, and which will also have a positive impact on the travel industry. So what could possibly go wrong? Like, who's the enemy of this story? There's four potential antagonists to this and factors that we're looking at. And we can get into a ton of details here, but I'm just going to rattle them off real quick. It's the extended COVID-19 headwinds. Now, Omicron has resulted in a spike in cases, but the view among scientists seems to be that it will help accelerate our way to it. So let's hang on and look at how things materialize. Supply chain bottlenecks. We have to see those we already started seeing those bottlenecks begin to alleviate, and it's expected to improve going forward as well. Inflation going to be a sticky. We already heard this mentioned already, but sticky about 3% at the beginning of the year. However, we do expect it to begin subside as we head into the second half of 2022, as the Fed rushing down on the bond purchases and likelihood of interest rate hikes in the second half of the year. Now, lastly, looking at labor force constraints, so we expect that to continue through the year and perhaps into 2023 as well, but not going to be a deal killer due to labor force participation rates expected to improve. So while all are representing headwinds and risks, they are all expected to improve as we move through the year. Lastly, just real quick, uncomfortable inflation to ease in second half of 2022 and into 23 as the Fed are adding more policies and increases on the interest side. Now, lastly, positive indicators. Who's the hero of the story? Consumers have been the hero of the story. While there's still some uncertainty tied to the business travel and group travel, on the consumer side, we continue to see improvement in terms of travel sentiment. This is from a survey that MMGY Travel Intelligence do on a quarterly basis for US consumers. And the travel sentiment index is at an all-time high for them. We continue to see, it's a little tough to read this slide, I apologize, but as the header explains, the intentions to travel remain high, while we are seeing some concerns in terms of COVID and an increased maybe fear among the population. 9 in 10 US consumers and travelers are planning a trip within the next 6 months. And 8 in 10 are saying that they are ready to go now. So there's still a lot of positivity related to this on the consumer travel side. And lastly, US DMO website searches remain well above 2019 levels, showing great intent to travel. People are looking for experiences, whether they be at attractions, a destination as a whole, or certain other areas. So I think that what we're seeing and what we're expecting to see is a happy ending. We're going to continue to see improvement throughout the year. The travel industry has been an extremely resilient industry historically, and we expect the same outcome this time around. So I'm happy to answer any questions on that as we move through the panel. Thank you.
Thank you, Erik. Really thank you to all of our panelists for these opening thoughts. You know, I had a question lined up for each of you, but wouldn't you know it, you answered my question before I even got the chance to answer them, like you always do, like a good panelist always does, anticipates the questions. So I'm going to pivot a little bit here and throw you guys each another question to get some conversation going. This first one's for Jamie. You know, this occurred to me while you were talking. Based on your earlier comments, it sounds like, you know, you agree that you agree with sort of with the Fed that these high inflation rates are temporary, transitory, whatever the word is. I'm curious what advice, you know, what specific advice you can offer to our audience in terms of how a financial manager can responsibly plan in the face of uncertainty, right? Should they just take everyone's word for it that things are going to turn around, or are there specific sort of fail safes or plans that they need to be making over the next 12 or 24 months?
Well, that's a very difficult question, Zach. And I sympathize with all the planners out there, especially with regard to the labor force situation, which, as Erik had that beautiful slide of the quits and the job openings, there's so much churn going on that it is hard to see through to a more stable situation. With regard to inflation, I think that it's something that there are different views on, and there are different risks. I think one way to look at it is to have have a central scenario for a planner to say, okay, here's my budget. For our central scenario, we'll use, let's say, the forecast that the Federal Reserve has put out, which I believe they're expecting inflation to be between 3% and 4% for the year 2022. So that could be a good central scenario, but I think one would also wish to include a higher inflation scenario, perhaps with less probability, maybe 25% probability that inflation would remain higher in the 5% range in 2022. It's certainly possible. We just don't know what will happen with some of the key inputs to our economy, specifically energy prices and labor prices. So it's a difficult planning scenario. There is a wide variety of views about what will happen to inflation, and it's certainly easier to plan over a 3 to 5 year horizon. I think that most economists would agree that the intention signaled by the Federal Reserve to keep inflation at a moderate level of around the 2% objective that they have adopted over the last, since the 1990s, that intention alone will coordinate the decision-making of many parties within the economy and will constrain inflation over the 3 to 5 year time period. But it's much harder to engineer that over a 1 year period. So I would say that planning over the 5 year period, if you're doing a 5 year plan for the facility you're planning for, there I would feel more comfortable with saying, well, inflation will be between 1% and 3%, where we've seen it, for 20 years. But over the next 2 year period, I think, first of all, people expect inflation to run 3 to 4% in 2022, and it may well be above that. But I wouldn't say a high inflation scenario, let's say 5%, should be the central scenario for a planner.
So just to paraphrase, we have to be ready for everything all the time, right, Jamie?
Well, I think that we, of course, should be ready for everything. We just lived through a pandemic, and are living through a pandemic, which we still don't know the outcome of, and we have no idea what will happen in 2022. But I think that the idea is not that we should be expecting everything with equal probability. We should have a central scenario where, let's say, the mass of our probability, 2/3 of our probability, is within the range that the Federal Reserve, for example, expects inflation in 2022. So that's you're on safe ground there. But some probability, a small share of probability, maybe 1/3, can address the risks that inflation will be higher and perhaps a little bit more persistent than the Federal Reserve is attempting to achieve. And I think that's a good planning scenario. No, I don't think we should be completely saying, oh, anything can happen with equal probability. But I do think that to build some risk into your planning scenario is wise.
Thank you. This next question, this is for Erik and also for Jerry. I'll ask Erik this first, and I don't know if you guys have your eye on the chat box, but our friend Bill Moore from the Zoo Miami Foundation, he actually kind of took the words right out of my mouth. I'm trying to paraphrase what he put in there. The context here is that really through the pandemic, generally speaking, this isn't true of all zoos, but generally speaking, many zoos have done quite well during the pandemic. We're talking about, top 5 type years in terms of attendance. And, we've all postulated, guessed as to why, and the obvious thoughts have been, well, on one hand, they're outdoors, so people feel safe going there. On the other hand, with the decline in interstate and international travel, right, your local zoo is close to home and offers a quick getaway, and you don't have to get on a plane. So really, it feels like they've been the beneficiary of sort of the confluence of these circumstances. And I'm curious, Erik and Jerry, as the return to quote unquote normal happens, should zoos expect to continue to be a beneficiary of pent-up demand, or are these other experiences, indoor experiences, further flung travel, are they going to start to eat into some of the upside that these outdoor attractions have seen over the last 18 months or so?
It's a great question. So the good news is that you've gotten over the last 18 months maybe exposure to a lot of people who may not have been to the zoos or other outdoor attractions in a while, and this is one of the things that they felt safe doing and okay doing in the environment that we're doing it in. You're absolutely right. I fully expect certain areas to be impacted tougher than others. If you're in New York City, you're going to have been impacted very differently than if you were in Miami. What we're seeing on the auto travel versus air travel, I don't necessarily expect that to change things too much. As we saw, the air travel is nearly back to 29, or not nearly back, but in 20% below where we were in 19. So there's a good amount of air travel already happening. Don't see that shift necessarily having a huge impact, but the number of trips that people take, it's been a little easier for people to leave home, going on a week vacation and working out of a hotel or an Airbnb or a vacation rental home. That's obviously most likely gonna those options probably gonna not necessarily go away, but gonna be less opportunity to do so. A lot of people had kids home from school over the last 18 months, and many parents kind of saw, I think, going to outdoor attractions as a nice escape as well. So it's tough to tell. It's tough to say for sure. It's kind of what we'll continue to see is you're going to have more competition, right? As some of these major cities and downtown areas start to kind of reopen in terms of restaurants and attractions and museums that they offer, yes, there's going to be more competition that you'll be facing. But again, perhaps some of what we've seen over the last 18 months of you getting maybe exposure to new customers, new clients, and maybe outweigh that. Just anecdotally, my wife continued to take the kids to the zoo at least once a month, and they are absolutely loving it. Did we do that once a month prior to the pandemic? We did not. We did it maybe 3 or 4 times a year. I think she's going to continue, but again, she might also go to some indoor activities as well. So it's extremely tough to predict, but the good news is that you've gotten some exposure over the last 18 months that you may not have been able to prior to that.
Thank you, Erik. Jerry, do you have anything to add on that? If not, I have I want to ask you a question about Erik's comment, but I will let you, if you want to respond to the last question, I'll allow you to.
The only thing I would add to that is the zoos, in addition to being outdoor, had the good fortune of appealing to the target audience that was most likely to move about: young people, families, higher income, and not traveling as far and staying local. And so, just in addition to it's outdoor, I have some natural social distance, I should be fine. I would also add that they had the target market that was the most willing to get outside. I think if you had your kids cooped up for months doing at-home learning, you were happy to get out with them to go do anything and anywhere. So anyway, just another observation.
So I just want to follow up a little bit, what I think is a little bit closer to home for you, Jerry. Erik mentioned kind of the reemergence of competition that had gone away for a little while, right? Movie theaters, restaurants, bars, travel. As somebody who does a lot of concept research, right? We, like Zoo Advisors, has done oodles of concept research with you guys over the past couple of years. Have you seen changes in the type of concepts that are performing well now versus what performed well, pre-pandemic, right? Should zoos and aquariums and botanic gardens be thinking differently about the types of concepts that they're developing for master plans or programming, things like that?
That's a broad question, because every location have their own story and their reason for testing capital. But in general, one trend I do see is the higher tech kinds of things that may not have been as welcome before are testing a little bit higher. People have become used to using online apps or curbside pickup or food delivery apps or what have you, and technology along with Zoom has had a nice push forward. And I believe as people start to engage more in that, it becomes more familiar. And as it becomes more familiar, then concepts that we test that have more elements that will either make the experience better or more convenient, easier, shorter line, a better guest experience overall. Probably seen a little higher there than we would before, but every concept test is very different because it's so unique to the individual location testing it.
Thank you, Jerry. James, I have a question for you. This is sort of in the context of the Great Resignation, or whatever we're calling it. Just thinking about all the talk recently about increasing wages, increasing minimum wages, people seeking better pay and compensation and lifestyles. Is it what it is for now? What are the long-term effects of this? Is the minimum wage going to be going up everywhere? Is compensation going to be rising everywhere? And if so, do organizations do they need to pass on the cost of that to their constituents? And if so, what does it mean for the larger economy if everybody's both making more money and also paying more for goods and services?
Well, I think what we've seen so far is that, and Erik had a nice slide on wage increases. The largest wage increases that we've seen over the last year have been in the lower paid job categories. And so I think this is something that we have no reason to expect will change that particular trend. I think that what people have experienced is that the low-paying jobs are not sustainable at the rates of pay and the working conditions that we've become used to in the United States. We're very anomalous compared to other advanced nations around the world. So I do believe that the lower paid job categories will wind up out of this experience in the next few years with significantly higher pay and benefits. That doesn't necessarily mean that the higher rates of the higher job categories, higher paying job categories will receive the same sort of wage increases. People who can work remotely, attend Zoom meetings and so on, arguably their job satisfaction has increased enormously, and their net pay has increased by the reduction in commuting things of that sort. But where the rubber hits the road are where people who have to go into work and they earn low pay. Those jobs have received much higher rates of pay. So I don't expect that to change. Now that change in the economy will lead to attempts by employers to improve productivity and to improve change their mix of capital and labor, and so the change in wages of a particular category of worker, the low-paid worker, need not lead to higher prices necessarily, but in the event that it does lead to higher prices, of course, then the low-paid workers are earning higher income, and so there's maybe a virtuous circle where that does not necessarily reduce the economic demand. In fact, it may lead to further growth. So the main thing I see is that, yes, this shift to higher paid, low income category jobs is probably a permanent shift.
So for organizations that serve, lower earning segments, I think we talk a lot about zoos and aquariums as being for the everyman, right? They're meant to be accessible to all segments of society. And as these organizations are facing, financial pressure, they're of course looking at their front gate and gate pricing as a way to help remediate these challenges. Do you have any thoughts about if increases in wages for currently low earning workers will enable the organizations like these to command higher admissions fees? And this could be a question for James or Erik or Jerry. I'd love to hear what all of you think about that. How about you, Jerry? You do a lot of pricing research.
Yeah, I would say the average zoo has more pricing room than they think they do. It depends on the combination and the individual environment and what have you. But typically in predictive pricing studies, we'll come back and say, if you package or present or offer it this way, there's probably several points of additional price that you could be charging. In this environment right now, your consumers almost expect prices are going to go up because they're seeing inflation everywhere. And probably the most famous thing is if you're going to do it, always try to give them a reason why. And right now why is because inflation, labor's costing more, my supplies are costing more. So I need to take it at an increase at the front gate. And they're pretty accepting if they understand what's going on. So 22 may be an opportunity to increase it at the front gate simply because consumers are at a point that they're ready to get out, ready to splurge, have the money to spend, but also kind of understand the world around us that the prices are going up on virtually everything. So I do think there's a window.
So a quick follow-up on that. Can you speculate as to why zoos and aquariums have been so underpriced for so long? Do you have any thoughts about why they've undervalued themselves? Has it been a lack of information? Is there something particular about this market that has perpetuated that thinking?
I think in historically, it's been, I think most people have been of the belief that consumers don't necessarily are very careful of what they're spending their money on, right? I think what we've seen over the last 18 months is if there's a will, there's a way, and we've seen, just taking prices on attractions. The inflations that we're talking about too, just to be clear, it's not necessarily wage driven, right? It's the cost of the goods sold that's driving a lot of that. On the travel side, we've seen some pretty high average daily rates at hotels, for example, remaining high. and continue to remain high. And we're just waiting for them to go down, and they're just kind of already above 19 levels, and they're not budging, right? On the zoos and the aquarium side or other attraction side as well, I think you do have an opportunity to kind of to stay strong and hold those price increases or hikes that you've been doing over the last few months. To Jerry's point, people are more understanding of it, and it's always tougher to go the other way and then bring it back up. Now, one of the things that reasons for why there's been an appetite is obviously, again, because of the strong financial position that the consumers have been in over the last 18 months, and that's not going to last forever. So there's always going to be a competitive side to this. Now, the good news is that historically, travel and tourism in general, whether that's going to recreational type attractions or museums or trips or other things, have had a pretty big share of the consumer wallet, and we're starting to see that getting more and more back to normal.
Thank you, Erik. As we kind of come to the end of our hour here, I just want to kind of reflect on what I'm hearing from you guys. Listening to Jamie, I'm hearing is that inflation is here, and it's real, and maybe it's transitory, but it's here for now. This upward wage pressure, particularly in low earning segments, is real, and that's going to have impacts on how organizations plan. On one hand, on the other hand, I'm hearing from Erik that there's optimism about the rebound in travel and tourism. Hopefully that's a good thing for zoos and aquariums and botanic gardens, but I think it's a question mark whether that actually is. I think it depends on the organization. And from Jerry, I'm hearing that what we always hear from Jerry, that this is that looking at your front gate, looking at pricing, better opportunity than maybe any time to think about taking advantage of those levers, those big buttons you can push to figure out how to get more value out of your visitors, and perhaps that consumers may be expecting it more now than they have currently. So unless there are any other questions from our audience, if there are, throw them in the chat or raise your hand or hop in. Otherwise, hold your peace. But absent that, I just want to thank Jamie and Jerry and Erik for their time today. It was fascinating hearing you guys talk about your expertise. I sincerely appreciate it. I'm sure the rest of our audience does also. So thank you so much.
Thank you.
All of our attendees for cutting out an hour to spend with us today.
Thank you, Zach, David. Appreciate it.
Have a good day.
Thank you.
Thank you, guys.
Pleasure.